Here's how to start trading cryptocurrency in 10 actionable steps, timestamps in the description. When you trade crypto, you will be interacting with stable coins all of the time. What are stable coins? Well, it's a crypto version of the dollar or other fiat currencies. But when we trade crypto, we value all of these cryptos in dollars. Bitcoin is $23,000 in value, Ethereum $1,600 in value. So we need stable coins to purchase cryptos and then sell out back into bank accounts if we want to do that. Which stable coins should we use? Well, there's fiat-backed stable coins here, and then there's crypto-backed stable coins here. So let's go over the pros and cons of each. The fiat-backed stable coins are backed one for one by cash or near cash assets in a bank account. So when you give, let's say $10 to your crypto platform, so we'll go on to Bybit, and we'll wire in some actual real dollars into Bybit's account. They're going to give us a stable coin, most of the time US dollar Tether. You can choose other ones. And so you're giving 10 to Bybit. Bybit are then using that crypto to give you those $10 back. But at all times, Bybit or other exchanges can actually take those dollars, put them back into these bank accounts, and get the actual dollars back. So each dollar stablecoin is backed by $1 of assets in an account. And that means the market will always trade these extremely close to $1, because if this stablecoin gets to 99 cents, then people are literally buying $1 for 99 cents. Hence why they keep their peg to $1 extremely close. How about crypto-backed stablecoins? These do not use US dollars in a bank account to keep the $1 asset. For this example, this is DAI, the most popular and largest crypto-backed stablecoin. They don't have dollars in a bank account. What they use is the value of crypto assets. For example, ETH, wrapped Bitcoin, and other assets. And I'll show you exactly what's backing this right now. As you can see, DAI has about $8 billion in value locked up in its system. Most of that is made up of ETH, wrapped staked ETH, which is a similar thing. You also have a bunch of other stable coins, for example, USDC. So there's $8 billion locked up right here. And as you can see, that value is creating DAI stablecoin at a collateralization ratio of 140%. So what we can know by that is for each dollar of DAI, there's $1.40 of crypto assets backing that value. That's because those assets aren't dollars and they're risk assets, and they can go up and down in value quite quickly. So what the algorithm does is essentially when this asset value falls, it's going to sell some of those crypto assets and then buy back DAI itself to keep this dollar peg at $1 and then burn the DAI out of existence. So that collateralization ratio is always quite high. The reason for this is because this allows for users to hold an asset that has a dollar value that isn't linked to the fiat world, that could be censored in some way. And so that's why DAI exists. Which one should you use? I believe for most normal retail investors, fiat-backed stablecoins, just take out all of the crypto stuff. And for every crypto dollar that you have, it's redeemable for one actual dollar. If you are trading crypto, check the deposit bonus to Bybit in the description. One of the exchanges I use the most, up to $4,000 as a deposit bonus if you are trading. So check the details via that link. We're going to get on to time horizon though. What I believe is that we can set up a long-term portfolio over decades, because we're going to live decades, hopefully, and so we need to sort that out. And then we can take a small portion of our portfolio and trade that over potentially days and years as well to get some small outperformance there if we think we can. So how do we actually research assets that are going to perform over the long term, over decades? It's not price action. It's based on other more fundamental techniques, which I'll highlight one here. It's the risk-adjusted return of assets over time. I'll link these down in the description as well, so you can take a look for these yourself. This is what's known as the Sharpe ratio. It is a measurement of not just the return over time, but the risk-adjusted return, right? So as we know, the S&P returns maybe 8 to 10% a year, or at least it has done over the last generation. Well, how much risk are you taking for that 8 to 10% return? Bitcoin is way more volatile, but actually, are you getting paid to take that volatility over the long term? And do you get more returns based on that volatility? And the answer is yes. Bitcoin, as you can see, the orange line here is the best Sharpe ratio asset. It has, despite its volatility, the best risk-adjusted returns versus gold, Ethereum, stocks, real estate, bonds, and emerging currencies. So if you're a long-term investor, this type of thing is what you should be looking at, not short-term price action. Also, over the long term, you really want to be looking at price charts over weeks and not days or hours. And so what I do, especially with network adoption, is really look at logarithmic regressions. And as we can see here, the blue line is really a very long-term, log regression of the price of Bitcoin over time. And so what we're looking at over the long term is this is an asset that's going up in value, and it has a higher Sharpe ratio than the stock market or real estate. And that's quite good for long-term investors. So that's obviously very encouraging. So what we can do is then look at the very long-term cycles of Bitcoin and say, we want to be picking up way more as a long-term investor towards the bottom of cycles. Now you're taking huge price differences here. This could be you buying at 7,000 and 3,000. You may say, wow, that's a big difference, 100% difference. In the big scheme of things over the long term, you actually make way more money over decades by choosing assets that outperform over that time scale. And so you need very large assets. Altcoins are not going to outperform over that time scale if they're small, if they're games. They have a short life cycle. Long life cycle assets, getting on them early is definitely the way to outperform over the long term. If you are investing over the long term, especially in Bitcoin, you will hear dollar cost average and HODL. But is that the best strategy? Dollar cost averaging is when you take a set amount of your income and invest it at a regular interval, weekly, monthly, or whatever it is. Dollar cost averaging does not outperform lump sum investing. The thing that outperforms is buying the most amount at the cheapest possible price, given that we assume that over the long term, the asset that we're investing in goes up, right? And so Bitcoin has during its life cycle so far. So what we want to do actually is buy the most at the earliest possible point. Now, that doesn't work for most of us because most of us have an income and we don't earn our life's income at one lump sum. And so what we can do is check for essentially periods where the price is relatively cheaper and actually buy more at that time. And so this is the Bitcoin cycle. As you can see here, we have essentially a top every 4 years or so. And then we have a sell-off back into the regression line. So as a dollar cost averager or a long-term investor, you can actually say, I'm going to buy more during the time when Bitcoin is nearer its regression in its uptrend, and I'm going to buy less when it's really in the bull market. And that's essentially a way to try and buy at cheaper prices. So if you're a really long-term investor, maybe this doesn't matter, but you can actually dollar cost average and put more in when the price is relatively lower, and maybe just scale back your DCAs as the price rises. Next, when buying crypto assets, we can decide what we actually want to get exposure to and how that's going to affect our investments. So a stark example and a difference here is the difference between Bitcoin and an altcoin, something like Mana, which is Decentraland, which is a game, really bad game, but Bitcoin has around 1 million daily active users and is valued at 400 billion. Mana has 8,000 daily active users, maybe less now, and is valued at 1.4 billion. I would say that this one is actually much better value, even though it's a higher market cap than something like Mana. This would be overvalued in my opinion because it's so terrible. What are we actually getting exposure to when we buy one coin versus another? When you buy Bitcoin, Bitcoin at this point is a massive worldwide store of value where different people use it to store and spend value over time. The reason why it is so diversified as one single asset is because you have different people in different countries storing and spending value at different times. So you may have one sector of the economy that's doing very poorly, and so the people that are using Bitcoin are going to be spending their value from it to fund their lifestyles because they may be feeling worse off. And then you have other parts of the economy that may be doing quite well, and they're going to be storing more value in it over time because they're feeling better off. And so overall, what you get exposure to is essentially the world economy of people that use it. And because Bitcoin is a closed-ended fund, it only has a certain amount of coins, then essentially what you're getting exposure to is a worldwide, broad-based, diversified financial index. That's what Bitcoin is. So it's one investment to make a worldwide broad exposure investment. When you are trading one singular altcoin, you have extremely high levels of risk that altcoin will fail. Most projects, most companies, given enough time, will actually fail. And so what we can do, especially with altcoins, is decide what areas of the crypto space we want to gain exposure to. Do you want exposure to gaming? Do you want exposure to liquid staking versus DeFi versus something else? And maybe even with your research, maybe some of these won't do too well over the long term. And so getting some sort of a basket of goods, for example, smart contract chains exposure, DeFi exposure, some of those are going to do better than you think, and some are going to do worse. That is how to gain a kind of a broad-based exposure with altcoins versus Bitcoin, which is just a worldwide financial index. A major downside of investing in altcoins, especially when you're early, is the fact that early stage assets need to fund their development. And so what happens is you get these huge bloated, what's known as fully diluted valuations, FDV. When you're making decisions on what you want to buy and sell, what you really have to look for as well is not just the price, but how the fully diluted valuation is in relation to the price. So as an example, we have two coins right here that have really high fully diluted valuations that can trick a lot of people. If we look at Aptos right now on something like CoinGecko, you can see the price right here, and it's done really well over the last week or so. But if we look across to the fully diluted valuation, you can just toggle this on right here pretty easily. Just go to fully diluted and you can see this. What we have with Aptos is a project that on the surface is valued at 3 billion. So you could say, well, 3 billion, maybe it can double quite easily and, get to 6 billion if it's used. But the actual fully diluted valuation is $18 billion. That puts it essentially as one of the top 5 cryptocurrencies in the world. Bearing in mind, it launched 6 months ago and has no users. So this is part of the definite thing you need to avoid in cryptocurrency is when you see cryptos that have the vast majority of coins still locked up, ready to get dumped on the market from early investors or from stakers, then you definitely don't want to get sucked into buying something just because the price has gone up. What actually happens with a lot of these assets is that the very small amount of coins that are actually in existence creates this trading regime where one small movement either side can trigger these huge liquidations, either short or long. And so you get these massive price discrepancies over the short term. And this can last for, even a year or so, especially during a bull market. But for me and for other people who are fundamentally investing here, you can't invest in something that has no users that's worth $20 billion. What I mean by fully diluted is what you can see is this is the Aptos inflation schedule. Over the next few years, there are going to be a hurricane, a flood of new coins, right, just coming onto the market all of the time. These are from people who are stakers. As you can see here, this is egregious that investors, core contributors, these are basically early investors who are getting new coins for free. Guess what they're going to be doing? They're going to be dumping it. So this is going to keep the price of this way down. If you're investing over many years, this is something to take into account, is that all of this money is going to be dumped onto the market. That doesn't mean that the price has to go to zero, but it does mean that Aptos has to create a ton of value over the next few years in order for that selling pressure to be actually met with fundamental buyers that want to pay an $18 billion valuation for this token. So FDV is really important because it can trick you and get you stuck in the top when the price comes down when those tokens are getting sold. You will be told by many TradFi investors that crypto has no fundamental value. Well, that's obviously wrong. So what we're going to look at is researching cryptos and how to place valuations on them. Daily active users, how many people are actually using something. It's quite important. Obviously, the more the better. Fees. How much is the blockchain or the application charging its users for fees? Incentives. How many tokens are the blockchain or the application paying out for free as an incentive to get people to use them? For example, if you use an exchange, you may get some incentives whenever you trade or whenever you provide liquidity on a DEX, you can get some tokens from the DEX as like an incentive that actually have a value. And so what they're essentially doing with incentives is paying you money to use them. Now that's good in the short term, long term, not so great. And then revenue is essentially fees minus incentives. Like, are they paying you more money to use it than they're actually making or not? And so what we can use is fundamental analysis tool like Token Terminal. This is completely free. I'll leave a link to them in the description. So we can see right here very quickly, and we can search by all of the assets that actually make revenue. So right up here, you have Ethereum, OpenSea, which is trading of NFTs, Uniswap, trading of fungible tokens, Lido Finance, which is a staker and validator kind of ecosystem. And so we can actually see the annualized fees that they're making. Now, what you can do from that, click into one of them, and fees are what they earn, but the revenue is essentially what they earn minus what they pay out. And so the revenue, as you can see, over the last 30 days is around 3 million. That would be, let's say, around 30 million in revenue to the token per year. That's pretty good. Now, the way that tokens actually bring value back to investors is by two ways. Either they just put all of the profits in a DAO, and so eventually the DAO holders can actually vote for the treasury to get returned to them. So that's like a dividend or a payout. The other way is for the DAO to actually, or the blockchain, to actually buy back tokens. So that's like a share buyback. So even though this isn't a blockchain, it's really a service provider. It's like a decentralized business, kind of not decentralized, but they do make money, and they do have a mechanism to actually return value to token holders. Is this a security? Probably yes. And it will be regulated as such, I'm sure, but we'll leave that to the regulators. But there is value accrual mechanisms within crypto, and you can actually value these a little bit like you value equities by how much they make and how much they return to investors. Next, when trading crypto, we can look at price action to give ourselves some levels of where the price may get to, and some important levels that we can trade against if we're day trading, trading short term, or if we just want some extra kind of info about what's happening, in real time. So as you can see here, this is the ETH chart. I'll leave links to trading systems below with deposit bonuses. Also, TradingView is completely free, so link to them down in the description. You can sign up completely free and use this. It's great. A lot of people use it. So as you can see down here, we have a sell-off. So this is a downtrend, definite downtrend. This is when Ethereum was in a big downtrend in the last bear market. And then we have this, which is a trend reversal. So we have downtrend, we have some choppy trade, which is signaling a trend reversal up into the next up move. So what I'm going to do here is use this as an opportunity to put support and resistance on the chart. Next time that the price moves down to one of these levels, we could potentially go into some shorter term trades, or just have it as in our mind where the price is going. So first thing, I want to use this as a support level. So I'm going to get my horizontal ray right here, and I'm just going to click this price action right here, and it's going to draw a ray out to the future. Then what I'm going to do is draw another ray, and I would say that this is a definite top, right? This is the mid-term price action top where the price rose, got rejected off of and went down. So I'm going to use this as an area to put a resistance line. This is support to the downside and resistance to the upside. What I can also see here is what is essentially, looks like a head and shoulders pattern, right? So you got the shoulder, you got the head, then you got the shoulder, and probably a rejection down. But this is definitely where a lot of trade is occurring. You can see around here, we get this resistance, we flip it, turns into support here, and then up here it has resistance again, but we flip it and it turns into resistance again. So what I'm going to do here is, I feel like this area is probably a really important area to just draw a kind of rectangle over and say, this price action here is probably quite important, around $1,500. Now that's a nice even price number that humans trade around. So what we can do now in the next phase of the market is we look over, and what can we see is that essentially if we draw this out, we actually meet resistance here twice more, right? So we're going to get the rectangle brush, and we see this is obviously an important price area. When we reject down, if we are looking to trade short term, when we go up, where do you think we're going to get stuck to? We're going to get right here with this resistance area. So that would be a short-term trade that you could possibly get into. Now we get rejected from this again. And so we could either play the rejection by shorting it, Or next time we have an upswing, like you can see here, we're just getting some bullish price action. You can actually say, I'm just going to try and buy along here and then take profits in this rejection area. And so what I've got from that price action is areas in the chart to trade short term, or just to give me some ideas of where the price might go to. If we get another bullish turn in the market from this level, then I would be looking at this price level as an area where it could get to, or if it's very bullish, we go up to this price level. And so getting price levels on the chart from support and resistance gives you extra information if you want to day trade, or just gives you extra information generally. Next, if you are trading short term, especially in altcoins, you can use different order types to limit your risk, or at least confirm some of your profits. So I'll show you what a conditional order is. I'm sure you've heard of market orders and limit orders. A market order is where you don't choose the price, you just trade an amount. Limit order is where you choose the amount and the price that you pay. But a conditional order is great to lock in profits of a certain amount or stop any further losses that might happen. And so this is great in the spot market, but if you're trading in the futures market as well, you can really use these. How a conditional order works is it only enters an order into the system once a price is triggered. And that's different than a limit order. For example, if you have an asset that's trading at 100 right here, and you don't want to sell yet, but you want to take profits, like if the price starts coming down and you're actually in profit, let's say you bought at 30 and you're in big profit right now, but you don't want to kind of sell now. And what you want to do is lock in a profit. So if the price comes down to 50, then you want to say, okay, sell me out, right? So you want to tell the system, sell me out. If you don't want to track this daily yourself, it might happen overnight or something. What you can do is give the system a conditional order. So if I use a limit order and I say, sell this crypto with a limit price of 50, if the price is 100 right here, it's going to sell me straight away because I'm telling the system, sell everything right now with a limit of 50. If the price is 100, what the system is going to think is, I've just got you a better price. Your lower limit was 50. I managed to sell at 100. So you don't want to do that because you're happy for the position to ride out, but only if the price starts coming down. You want to make sure that at 50, you're locking in some profits. So what you have to do is use one of two different types of order. You can use a trailing stop loss and say to the system, if the price from 100 moves 10% below, then you can sell out. If your system has a trailing stop loss, you can do that. So what a trailing stop loss does is move up with the order at 10%. And as it moves down, it doesn't move. So it just stays 10%. If the price goes down 10%, you sell out. With a conditional order, you set all of the parameters. So what I can do with a conditional, let's say I'm in big profit here and I bought in at 6, price is now 17, but this isn't going to last. It's going to dump. And so I want to make sure that I, lock in profits at around 14. I want to give the trade some room in case it pulls back and then moves up. But here, if it's kind of really, coming down, I want to lock in my profits. So what I can say is to the system, at 14, enter a sale for me at 14. And so what that will do is not sell anything, but if it gets to 14, then it's going to sell me out at 14. A limit order wouldn't work because if your limit's 14 and the price is 17, you'll trade straight away. So that is a way that you can actually manage positions, especially overnight. This stuff is really volatile, where you can actually lock in profits. If it's coming down, you can lock in profits, or you can use conditional orders as a stop loss as well to actually lock in a small loss and prevent the position getting well away from you. Next, many people in crypto actually use crypto futures to trade over the short term. What is the benefit and the downside of this? Futures allow you to use leverage, which is very risky. I don't recommend leverage, but let's see how to actually go ahead and do this. So when you trade crypto futures, you can either take a long position that is benefiting when the price goes up and then selling out the position at a higher price. You can also take a short position where you actually sell first. So you sell the price first and then buy it back lower and then take advantage of the price coming down. That's one of the advantage of futures. The other is leverage that people use. Now, I would use leverage as a way of putting less of my assets on a trading platform. So a lot of people use it to just trade with much more than they actually have, which is where you're going to get in trouble. So What we can do is choose the amount of leverage that we want. Let's say we want to choose 5x leverage and press confirm. How to actually, go ahead and trade right here. Let's say that we want a $10,000 position. So we can do that by the order value. We have 10,000, but because we're using leverage, as you can see, we only need $2,000 down. And so we're using 5x, 2 times 5 is obviously 10,000. So the position that you have in the market is $10,000, but you only have a $2,000 position down. Now that $2,000 is used as collateral to fund any potential losses. And so with a 5x leverage, if that $10,000 position moves 20% down to the downside or to the upside, if you're in a loss 20%, then your entire position is wrecked. So leverage basically makes losses and wins much higher. And with leverage, what I would do is just use it to open the same value of the position that I would want and just put less of my assets on the exchange, because if you're trading assets that can be staked and you're a long-term investor, you can actually still get revenues from them, plus using less of your assets on an exchange. So leverage is very dangerous, but it can be used responsibly in some instances. Next, with crypto, we want to make sure at a fundamental level that our assets and our investment assets are safe. It's really two ways to think about this. The first is just to use the most regulated custodian in your country. For example, Coinbase, it's a listed entity, 99.9% you're going to be fine on there. But if you have larger amounts of crypto, you may want to look into getting a wallet. I think wallets are great to use anyway. You store the assets yourself, and so insolvencies, nothing like that can take place. Now, you can still lose money when using wallets for sure. If you click on the wrong type of link, if you click on a link that's going to drain your wallet, that could actually happen. And so for the assets that you want as part of your long-term investment portfolio, I think you just need to get them into a hardware wallet and just leave them there and never kind of use them. That's why if you want to trade short term, people use leverage because they can put less down in the exchange, which means that they can store more away in their very, very safe option. So wallets like Trust Wallet are decent, but they still have the keys that are your private keys on your device, like your phone. What's better is like a hardware wallet, like Ledger, and essentially they keep your keys offline. And so what you need to do here is just get the Ledger, you have a recovery phrase, and that recovery phrase, as long as you keep it safe, is essentially offline at all times. And so for your investment assets, Ledger or a hardware wallet is, really, really something that we could take advantage of. My Crypto Investor course now has 300 videos that take you step by step through the entire crypto industry. Check that via the link in the description down below. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.